With just the beginning of the new financial year, there's lots to do. And the new year, where we don't plan to spend but instead plan to save, definitely matters more, right? So, on the same note, we thought why not take the first step into the financial year and mark our calendars together. Hello and welcome to Untaxing Taxes. My name is Riddhima Sharma, and here at Quicko, we help hundreds of thousands of taxpayers file their taxes. With the new financial year just starting out, taxpayers will have to choose between the old versus the new tax regime. With the new tax regime, where tax filing has become much simpler, did tax planning get easier too? Now, where the old tax regime offers you the ability to claim Chapter 6A deductions, the new tax regime has lower slab rates. Just because you can claim deductions under the old tax regime, it won't make sense for you to invest an arbitrary amount yearly in any investment just for the sake of tax savings. You need to make a calculated decision while opting for a regime. Majorly, you need to evaluate three things. The first step while choosing a regime is to see what income slab you fall in. This will help determine what tax rate applies to you. If your taxable income is less than 5 lakhs, then the tax rates are the same under both the regimes. Now, while the tax rate for income over 15 lakhs is also the same, that is 30% under both the regimes, the tax payable will not be universal. This depends on the total taxable income, which may differ based on the exemptions and deductions available to you. The ability to claim deductions is the primary difference between both regimes. You need to keep in mind the deductions that you would be giving up if you go with the new tax regime. Make sure that the investments that you make are not just for tax saving benefits, but also contribute to long-term financial security, especially when you're just starting out. Let us briefly understand the primary deductions and exemptions that are available under the old and the new tax regime. A standard deduction of Rs 50,000 is automatically provided to all salaried individuals under the old tax regime. This deduction is no longer available under the new tax regime. Under the old tax regime, various investments made in ELSS mutual funds, EPF, PPF, insurance premiums, etc. can be claimed as deductions under Section 80C. The maximum deduction allowed here is Rs 1.5 lakhs. You cannot claim these deductions if you opt for the new tax regime. Salaried individuals staying in rented accommodations can claim a certain amount of rent paid as an exemption under the old tax regime. If you stay in a metro city like Chennai, Kolkata, Mumbai or Delhi, 50% of your basic salary can be claimed as an exemption under HRA. In case of a non-metro city, the percentage is 40. While opting for the new tax regime, HRA cannot be claimed as an exemption. In addition to HRA, other Section 10 allowances like transport, conveyance, daily allowances that are available under the old tax regime have been taken away with the new regime. Under the old tax regime, you can set off losses made from house property against any other income head like business and profession, salary, capital gains, etc. Moreover, you can also carry forward these losses to another financial year. As per the new regime, losses from house property can be set off only against other income from house property. Also, it is not possible to carry forward these losses. In case of a self-occupied house property, you can claim a deduction of up to Rs 2 lakh on the interest under the old regime. Under the new regime, this deduction is not available. If a loan was taken after 1st April 1999 with the purpose of purchase or construction of a new property, then that entire amount can be claimed as a deduction under the old tax regime, given that the construction or purchase was completed within 5 years from the end of the financial year when the loan was taken. Under the new tax regime, individuals can claim interest on home loans for let-out properties only up to the amount of the rental income. If you have served at least 5 years of continuous service, gratuity received up to 20 lakhs is tax exempt under both old and the new regime. If you have received leave encashment upon resignation or retirement, up to Rs 3 lakhs can be claimed as an exemption under both the regimes. Now, before you make a decision, you should have calculated your total tax payable under the old regime and the new one. To do so, you can use Quicko's income tax calculator, where you only need to enter your income details and deductions, and the calculator will inform you of your tax liability under both regimes. The link to the calculator is provided in the description below. In the first month of the financial year, that is April, you need to submit your Form 12BB to your employer and inform them of your preferred regime. Form 12BB is an investment declaration form to your employer where you need to declare all the deductions that you have planned for the year. The proofs for these investments need to be submitted towards the last quarter of the financial year. In accordance with the investment declarations that you make and submit subsequent proofs, your employer will calculate and deduct TDS on your behalf. You can keep track of the TDS deducted with the help of Form 16, which is essentially a certificate that TDS has been deducted on behalf of the employee. It also has details of your income for the whole financial year. Form 16 is issued by your employer by 15th June of the assessment year. It will come in handy when you're filing your return. The way you plan your taxes will solely depend on the regime you opt for at the start of the financial year. Where a salaried individual can switch between the old and the new regime every year, a non-salaried individual gets to make the choice only once. While with the new tax regime, the itemized deductions might have been taken away, it offers more disposable income and the freedom to pick up investments of choice. One of the goals of the new tax regime is to make us think beyond just tax-saving benefits. But does the government also want to keep us from investing in low-yielding products? With the new financial year just starting out, do let us know in the comments below if there is any topic you would like us to make less taxing. Hit the like button if you enjoyed the video, subscribe to Quicko if you haven't already, and hit the bell icon so you never miss an update from us.